Hello everyone, this is Vinod Prajapati, founder and CEO of Millions Worth Financial Services. In this video, we'll see how this increase in interest rates has affected home loan EMIs and what could be a solution for home loan borrowers. The repo rate maintained by RBI acts as a benchmark interest rate basis on which banks in India offer loans and accept deposits. In 2019, the repo rate was 5.4%, and we all know that as we entered 2020, the pandemic gripped us and impacted economic growth globally. To avoid a large scale closure of business units and maintain liquidity in the banking system, RBI reduced the repo rate to 4% in three meetings. As a result of this, the home loan interest rate too got revised to an all time low that is in the range of 6.5% to 6.75%. And the real estate market recorded record deals during this pandemic period. Now we are in third year from the start of this pandemic. Cases have reduced globally, most of the economies have opened, and now we are facing a hyperinflationary situation caused partly by higher demand on account of reopening of economies and partly because of supply side problems due to heightened geopolitical escalations between countries. This has caused the repo rate and interest rate across the globe reaching to a multi-year high. The situation in India is still under control, but some of the developed countries are facing interest rate at a multi-decadal high. So let's evaluate the impact on home loan EMIs. Let's assume that you had taken a home loan of rupees 1 crore at 6.75% interest rate last year for a 20-year period. Your EMI would have been rupees 76,000 approximately until May 2020. Since then, in every 2 months, your EMI would have revised upward on account of interest rate revisions. At present, you would be servicing your home loan at 8.5% to 9%, which means your EMI would have increased by more than 10,000 rupees a month. Rupees 10,000 may look a small amount, but at this interest rate, you'll end up paying approximately 25 lakh rupees more to your loan provider in your course of loan repayments. And there's a fair bit of chance that interest rate will increase more and thus your loan EMIs are likely to increase further. And by any chance, if you're not in a situation to afford this increase in EMI and opt for an increase in tenure of your home loan, you'll end up paying your home loan for additional 11 to 17 years from the initial repayment period. That means you'll end up paying extra 1 crore to 2.5 crore. So, what is the way out? Or is there a way out? Yes, shift to an overdraft based home loan. Let's see how that will be helpful. Here, your loan provider will also open an overdraft account for you. There, you can park your idle funds and, if required, you can withdraw that too. Thus, you maintain liquidity for your financial emergencies all time. And for this liquidity, the interest rate on this type of home loan is little higher. I have assumed a 0.25% higher rate of interest in this illustration. Let's assume that in last 1 year, you have been able to save some amount from your income, or you have a corpus maintained in a liquid fund or bank fixed deposit for your financial emergencies, or some amount is lying idle in your savings or current account due to your business needs. We need to place that amount into this overdraft account. Remember, whatever amount we'll keep in this overdraft account will get adjusted against the home loan principal amount, and a relatively larger part of your EMIs will go towards the repayment of the principal amount. In this illustration, you can see that if the borrower maintains approximately 17 to 20 lakhs in the overdraft account, he can avoid additional repayment in the form of higher EMI or longer loan tenures. Even if he is not having enough savings to avoid the complete impact of the interest rate rise, he can reduce the impact by maintaining a smaller amount in the overdraft account. And let's suppose the interest rate again starts falling, then they will be able to repay their home loans faster. This is happening because whatever amount is maintained in the overdraft account gets fully adjusted in real time basis against the outstanding loan amount. Therefore, a relatively bigger part of your EMIs are going towards the repayment of the principal amount. You would notice here that in future, if interest rate falls to 7% and 6%, your loan will get finished in around 13 years only, resulting in a savings of approximately 38 to 48 lakh rupees. Isn't this a great option? Before you take your decision to shift your loan to an overdraft based home loan account, please note that there will be no tax benefit on the balance that you will maintain in the overdraft account. And don't forget to evaluate stamp duty and processing fee before considering the transfer of your home loan.